Do you trust your bank? Most people assume banks are here to help them grow their wealth and keep their money safe. But what if I told you there are secrets banks don't want you to know, things that could be quietly draining your money without you even realizing it? Banks are businesses, and their goal is to make as much profit as possible, often at the expense of their customers. Today, we'll reveal 7 hidden truths about money that banks don't want you to know. If you care about your financial future, you need to hear this. Number 1. Banks make billions from hidden fees. Banks might seem like they provide free or low-cost services, but in reality, they make billions of dollars each year from hidden fees. These fees are often disguised in complicated banking terms, making it hard for customers to notice. One of the most notorious fees is the overdraft fee. If you accidentally spend more than what's in your account, the bank covers the transaction but charges you a hefty penalty, sometimes as high as $35 per overdraft. Many banks even manipulate transaction orders so that large payments process first, causing multiple overdrafts and increasing fees. Another sneaky charge is the monthly maintenance fee. Some banks charge you just for keeping an account open unless you meet specific conditions, like maintaining a high balance. Then there are ATM fees, wire transfer fees, and even inactivity fees if you don't use your account enough. These small charges add up over time, quietly eating away at your money. Number 2. Credit cards are designed to keep you in debt. Ever wonder why banks push credit cards so aggressively? That's because they make huge profits from interest rates and fees. Credit cards often come with high interest rates, sometimes exceeding 20%. If you don't pay your full balance each month, the interest charges quickly snowball, trapping you in a cycle of debt. Even worse, banks only require you to pay the minimum balance, which sounds convenient, but it's actually a trap. By paying just the minimum, most of your money goes toward interest and your debt barely shrinks. For example, if you owe $5,000 on a credit card with a 20% interest rate and only pay the minimum each month, it could take over 20 years to pay off, even if you never make another purchase. To avoid this, always try to pay your balance in full or at least pay more than the minimum. Credit cards can be useful, but only if you use them wisely. Number 3. Banks don't reward loyalty. Many people believe that sticking with one bank for years will give them better deals and special privileges. But in reality, banks often take loyal customers for granted while offering better rates and promotions to new customers. For example, if you have a savings account, your bank might offer you a low interest rate, while new customers get higher promotional rates to lure them in. The same happens with loans and mortgages. Existing customers rarely get the best deals because banks assume you won't bother looking elsewhere. That's why it's important to shop around and negotiate. If you find a better deal at another bank, don't be afraid to switch or ask your bank to match it. Loyalty doesn't always pay off in the banking world. Number 4. Your money isn't sitting in the bank. Many people believe that when they deposit money into their bank account, it simply stays there, safely stored until they need it. But the reality is quite different. Banks operate on a system called fractional reserve banking, which means they only keep a small fraction of deposits in reserve while loaning out the rest to earn profits. This system allows banks to continuously circulate money, but it also means that your deposits are not just sitting idly in a vault. For instance, if you deposit $10,000 into your account, the bank might only hold on to $1,000 while lending out the other $9,000 to borrowers. Whether it's individuals taking out personal loans, businesses securing funding, or even mortgages being issued. This practice enables banks to make money through interest, effectively creating more money in the economy. However, it also carries risks. If too many people withdraw their funds at once, the bank could face a liquidity crisis, meaning it doesn't have enough cash on hand to meet withdrawal demands. This is exactly what happens during bank runs, where panic causes mass withdrawals, sometimes leading to financial collapses. To protect yourself from such risks, financial experts often advise against keeping all your money in a single bank. Instead, consider diversifying your savings across multiple financial institutions. This way, if one bank encounters issues, your entire savings won't be at risk. Additionally, looking into safer investment options, such as government bonds, precious metals, or diversified portfolios, can help safeguard your wealth. Understanding how banks handle your money is crucial to making smarter financial decisions. While banks play a vital role in the economy, it's important to remember that your deposits are constantly moving rather than just sitting in an account. So, how can you better manage your wealth and ensure financial security? Let's dive into the next key insight. Number 5. Banks can take your money to pay your debts. Here's a scary fact. If you owe money to your bank, they have the legal right to take money from your account without asking for permission. This is called the right of set-off. For example, if you have a checking account and a credit card with the same bank, and you miss a credit card payment, the bank can automatically withdraw money from your checking account to cover the debt, even if it leaves you with nothing. To avoid this risk, it's a smart idea to keep your loans and checking accounts at different banks. That way, if you ever fall behind on a payment, your bank can't just take the money without warning. Number 6. Savings accounts don't protect you from inflation. Many people assume that keeping their money in a savings account is a secure way to preserve their wealth, but in reality, it can slowly erode your purchasing power. The reason is simple. Most banks offer minimal interest rates, typically far below the rate of inflation. While your account balance might increase slightly over time, the real value of your money is actually shrinking because the cost of living is rising much faster. To put this into perspective, imagine you have $10,000 in a savings account, earning 0.5% interest per year. After a year, your balance increases to $10,050. However, if inflation is at 3%, the actual worth of your money in terms of purchasing power drops to around $9,700. This means that while your bank statement shows a higher number, the amount of goods and services you can afford with that money has decreased. Over several years, this effect compounds, making traditional savings accounts a poor strategy for long-term wealth growth. A smarter approach is to explore alternative financial options that provide better returns. Number 7. Credit unions can be a better alternative to banks. Most people think banks are their only option for managing money, but credit unions can often be a better choice. Unlike banks, which are profit-driven, credit unions are non-profit organizations owned by their members. This means they often offer lower fees, better loan rates, and higher savings interest rates. Credit unions also tend to have better customer service because they prioritize their members rather than maximizing profits. Many credit unions provide the same services as traditional banks, including checking accounts, credit cards, and mortgages, but with fewer hidden fees and better terms. If you're tired of being charged unnecessary fees and getting low returns on your savings, consider switching to a credit union. You might be surprised by the benefits. Now that you know these 7 money secrets banks don't want you to know, what will you do differently? The banking system is designed to make money for them, not for you. But if you stay informed and make smart financial choices, you can protect and grow your wealth. Which of these money secrets surprised you the most? Let us know in the comments. And if you found this video helpful, make sure to like, subscribe, and share so more people can learn the truth about banks.